Hello and welcome, accounting students. In today's lesson, we are going to be focusing on partnerships, analysis, and interpretation. So just as I remind you at the beginning of every lesson, please make sure you're working with me. And in order for you to be able to work with me, obviously you need pen, paper, and your calculators in front of you. So let's get started. Right, now when we talk about analysis and interpretation, obviously we're referring to ratios, financial indicators. But why do we prepare ratios and financial indicators? Why is it necessary to do this comparison? So have you ever thought about how does ratio analysis and comparing previous and current financial statements assist a business in making important financial decisions? Why is it necessary to do this comparison? So that is what we're looking at in today's lesson, and obviously specifically in terms of a partnership. Right, now in terms of what we've done already, obviously we focused on unique transactions affecting a partnership. We then moved on to ledger accounts, final accounts. We looked at the preparation of financial statements. How does it change from a sole trader to a partnership? However, in each aspect of this concept map, there was a bit of analysis and interpretation. So again, that's where our focus is, where we've now prepared our financial statements and we are now ready to analyze, look a bit at the financial statements, look a bit closer at our financials. Right, so let's move on. Some of the key words in today's lesson that you may come across or I may talk on: risk and gearing, very, very important. Remember, opening a business, investing capital, there is obviously a certain degree of risk that the partners are taking. Similarly, if you look at banks, by they giving the business a loan, they are also taking a certain amount of financial risk. So we obviously going to be looking at risk, gearing. Is the business low risk? Is the business high risk? Then the next important concept, the word return. Now remember, in a partnership, you've obviously got two or more owners investing capital into the business. Now remember, no one's going to do it out of the goodness of their heart, or because I've got so much of time on my hands, let me now invest my money in this business. If I'm investing in a business, I expect something in return. What am I getting from my investment? Okay, so we're going to focus on returns. Then liquidity and solvency, very, very important. Remember, you came across this in previous years in grade 10, where you calculated a number of liquidity ratios. Solvency, you also looked at the solvency of a business in the event of the business converting total assets into cash. Is the business to pay off total liabilities in terms of solvency? And then finally, profitability. Again, not something new. We have come across this previously, but how profitable is the business? When you look at their income versus their expenses, is the business profitable? And again, we are comparing one financial year to the other. Has your operating expenses increased? Were you able to control? Were you able to monitor your expenses? So obviously, when we look at profitability, those are the questions we are referring to. Okay. Now, before we start with our very first example on analysis and interpretation, I just want to quickly go back to liquidity and solvency and the difference between the two. Because what we often find is that students confuse liquidity and solvency, and I don't want that to happen. So hopefully this is going to help you. If there is some kind of confusion, let's eliminate that confusion. Right, now when we talk on liquidity, when we talk about liquidity, remember, liquidity is the ability of the business to pay off its short-term debts. So when we talk about short-term debts, we are obviously referring to your creditors, we're referring to your bank overdraft, short-term debts. So is the business able to pay off its short-term debts after converting short-term assets into cash? Now remember, short-term assets, we're obviously referring to your stock. We're referring to debtors. We are referring to obviously your bank account, petty cash, cash float. That makes up your short-term assets. So when I convert my short-term assets into cash, am I able to pay off my short-term debts or my short-term liabilities? Okay. Right, what then is solvency? Now remember, solvency is still the ability to pay off, but this time total debt or total liability after converting total assets into cash. So here we are looking at all your debts, all your liability. The word total, current and non-current, your total debt, right? After converting total assets into cash. Or one may see it as, do you have enough total assets to cover total liabilities? So please make sure, guys, you take note of the difference between the two, liquidity and solvency. There is a difference, and often this is tested in your exams. Okay. Right, let's carry on now with our very first exercise. So let's go straight into an exercise. Again, work with me, make sure you understand the calculations. The best way to understand is by working and writing down the calculations as I explain. Right, so for our first example, we are given information, right? It's given from KT Tech. And we are asked to answer the questions. KT Tech stocks electronic equipment such as cell phones and tablets. So they're giving us a bit of information about the stock that this business sells. Okay, from the information given, I notice I'm given the current ratio, asset test ratio, debtors collection period, creditors payment period, as well as current liabilities. Right, so immediately I notice I am given a whole lot of liquidity ratios. Okay, so I'm given liquidity ratios for 2021, which is the current year, as well as 2020, which is the previous financial year. So that is the information, that is the table presented to me. Okay. Right, so let's look at our very first question. Calculate the inventory amount for 2021. Inventory, obviously your trading stock. What is the trading stock figure for 2021? So let's go back to our information that is given to us. Right, so looking at the information at the bottom, can you see I've got my current liability given to me? Obviously, there's no current assets. However, I am given the current ratio as well as the asset test ratio. So I'm going to use this information to now calculate inventory. Right, so let's now go to our answer sheet. There's two ways in which you could do the calculation. I'm going to show you both methods. You decide which method you prefer. So the first method is where I'm going to calculate what is my current assets with stock. Okay, so what is my current assets with stock? And then what is my current assets without stock? Okay. Right, so we're going to start off with current assets with stock. What is the figure? Okay, so if I go back to my information, so my current assets with stock, right, not given to me, but I'm obviously given the ratio of 3:1. So I want to write that down. So I'm given the ratio 3:1. Let's just go back, right? So the ratio 3:1, right? Or 3:1:1. Let's say that properly. It's 3:1:1. And my current asset ratio without stock, or my current assets rather, without stock, here I'm obviously looking at the asset test ratio, current assets without stock, asset test ratio, and if I go back, it's sitting at 0,9:1. Let's fill it in. So it is 0,9:1. Now, if we go back to the information, right, I already mentioned this and I circled it in the previous slide. I'm just duplicating the slide so it's easy for me. My current liability is given to me at 1,810,000. So current liability, 1,810,000. Okay, so obviously I have my current liability. So in order for me to calculate my current assets without stock, all I'm doing is taking 3,1, the ratio 3,1, and I'm multiplying this by 1,810,000, and that should give me my current assets with stock. So let's quickly grab the calculator. Right, so we've got 3.1 times 1,810,000. Let's just watch the zeros. And that gives me current assets with stock is sitting at 5,611,000. So 5,611,000. Right, now let's do the same and let's calculate what are current assets without stock, and obviously we're using the asset test ratio. So again, current liability is given to me as 1,810,000, and in order for me to calculate my current assets without stock, all I'm doing is taking the ratio 0,9 times 1,810,000. So let's again grab the calculator. Let's clear that. So I've got an amount of, right, 1,810,000, which is my current liability, times 0.9, and without stock, my current assets is 1,629,000. So 1,629,000. Okay. Right, now remember the question wants us to calculate what is inventory. So now it's absolutely simple. I've got my current assets with stock and I've got my current assets without stock. So obviously, if I take current assets with stock, subtract that, current assets minus stock, that would then give me my stock figure. So looking at your inventory amount, so again, I need my calculator. Let's quickly grab that, right? So I'm taking current assets with stock, 5,611,000 minus 1,629,000, and that gives me a stock value of 3,982,000. So let's fill that in, 3,982,000. Okay, right. As I mentioned earlier on, there are different ways in which you could do this calculation. I've used one method The other method, quite simple. I'm going to get the exact same answer. So let me just go back to the information because I don't have space to write on that page or on that screen. But here, all I've got to do, guys, watch very carefully. I'm using my ratios, right? So my ratio 3.1 with stock minus 0,9 without stock. So I'm not calculating my current assets with stock and without stock. I'm using the ratios. So my stock figure as a ratio, so let's grab the calculator, right? So if I take 3.1 minus 0,9, stock as a ratio is 2,2. Right, so we're getting the ratio of 2.2, and we're obviously multiplying this by our current liability figure, 1,810,000, right? And just to show you, I'm going to get the exact same figure that I did previously. So 2.2 times 1,810,000. Okay, and as you can see, I've got the exact same stock figure, guys, 3,982,000. So if we go back to our previous slide, let's just quickly go back. As you can see, 3,982,000. So I'm getting the exact same answer. Right, let's move on now to the next question. Okay, so the next question wants us to answer the following. Is the business keeping too much of stock? Explain with the aid of a calculation. Also explain the dangers of overstocking. Okay, so in the previous question, we calculated the amount of stock the business has on hand at the end of the year. They are now asking us, is the business keeping too much of stock? Explain with a calculation. Now, you can either refer to the current ratio, or you can compare the current ratio and the asset test ratio and work out the percentage of stock that is on hand compared to current assets. So that's what I want to do. I want to work out the percentage because now I'm showing a calculation. Right, so if we go back to our previous question, let's just quickly pull out the calculator. Remember, our stock was 3,982,000. So 3,982,000. If we now divide this by total current assets, right, with stock, so I'm just going to go back to the calculation on the previous slide. Let's just quickly find that. There we go, should be this one here. 5,611,000, so I just need that figure, 5,611,000. Right, this will give me the percentage of stock in comparison to total current assets. You guys got that? Total current assets, what is the percentage of stock? Right, so let's grab our calculator to work out this percentage. Okay, so I've got the stock figure already. Divide that by current assets, 5 million rather, 611,000. Okay, and then obviously I'm going to multiply that by 100 to give me a percentage, right? And the amount of stock on hand in comparison to current assets, 70,96%. So let's just write that down. Okay, so 70,96%. Right, now you could argue that this is a lot of stock on hand. This is too much of stock on hand. The business is, or the question rather, not the business, sorry. The question is asking you explain the dangers of overstocking. So before we get there, right, is the business keeping too much of stock on hand? I would argue yes. Okay, because my calculation is showing when I compare stock, cash, and debtors, total current assets, 70% of that is made up of stock. Right, so is the business keeping too much of stock on hand? Definitely yes. Right, are there advantages of having too much of stock in hand? They are, but the question doesn't want us to talk about the advantages. Okay, here the question is telling you, explain what are some of the dangers of overstocking. Okay, so remember earlier on when we looked at this particular business, obviously they stock electronic goods such as cell phones and iPads. Right at the beginning of the exercise, that was the information given. So what are some of the dangers of overstocking? Remember, with these type of products, technology comes into play. So the moment there is something new on the market, right, there's a change in technology or there's an advancement in technology, remember, the old stock will become outdated. No one wants the old stock anymore. They want to buy the latest cell phone or the latest iPad and so on. So there is a danger that the technology might be outdated in terms of this particular product. Another danger by having too much of stock on hand is in the event of the stock not selling, obviously that cash, your funds are now tied up in that particular stock. So those are some of the dangers of keeping too much of stock on hand. Okay, so remember guys, when you are answering, right, I've shown the calculation, I've said yes, and then talk about technology, right, and link it to the product. I'm not going to write everything down, but link this to the products that I've mentioned, and then talk about cash is tied up, okay, tied up in stock, and if it does not sell, obviously it's difficult to then convert that stock back into cash. Okay, right, so we're done with the second question. I think before we move on, because I feel I've done quite a bit in the segment, let's take a quick break, and when you guys return, we'll obviously continue with analysis and interpretation of financial statements. So I'll see you guys in a bit.